A few years ago, a bunch of people started to notice that banks, institutions, Wall Street corporations, and pension funds were buying up family homes all over the US. Really, this started to worry pretty much everyone because these billion-dollar corporations were the ones buying up your homes, not other individual people. They were then renting it out back to you, inflating home prices, and forcing you and many other people who aren't quite as fortunate as some others to rent forever. Now, that was a very scary prospect, and while it seemed to have started overnight, the reality is that this has been happening for years now. There have been instances of entire neighborhoods being bought up by institutions like this one behind me, where a brand new development of 121 individual houses was bought by one single company called Fundrise before they rented all those houses out to normal people. Of course, they bought these homes for twice the price that normal people would pay, and as a result of this, normal people just cannot compete with these institutions, and this has massively contributed to inflated house prices over recent years. Now, some months ago, back in the latter half of 2021, I made a video about just this topic, showing exactly what these banks are doing, explaining why and how it all happens, and it got a fair bit of attention. But the sad truth is that 99% of the people around you still don't know what's actually happening. We are revisiting this whole topic today though, and why is that? Well, because things aren't quite going as well for these banks, institutions, and Wall Street mega corporations as they would have hoped. The housing market in the US and in most other Western countries too is really on the precipice of a crash right now, and these banks know that well. Many of them are deciding to sell off their stock, and even more of them have stopped buying new homes altogether. All of this is happening as the next Great Recession kicks off for the 2020s, spelling disaster for the housing market and for the millions of people and some institutions who bought at prices that they simply can't afford. Now, before we get into the details of what's actually going on with these institutions, first we need to discuss very briefly why the housing market is in such peril. And of course, it all comes down to the COVID pandemic and the government response to that pandemic, and how none of the growth in the housing market that we saw over recent years came from natural forces. The housing boom that followed COVID was absolutely insane. It was the biggest we've ever seen in such a short amount of time, but it was also entirely artificial. It was all caused by government intervention, and it's obvious if you think about it. People should have been poorer than ever. Businesses closed, people weren't allowed to go out and work, but we all still got paid. This money was being printed by the government and sent out to our bank accounts, creating a zombie economy. To make matters even better for the average man, but worse in the long run for the market and the economy, we weren't working, but we were still getting paid, and we couldn't even save our money, so of course it just sat in our bank accounts and we started to save. At the same time as this happened, in an effort to stimulate the economy and ensure that there would be no housing market crash, the government started buying hundreds of billions of dollars worth of mortgage-backed securities, which prop up the housing market in the US. Of course, while this was happening, the government was also locking us in our homes for months. They didn't let us out to eat at restaurants. They didn't let us out to spend our money, to exercise, to live, to see our family. And so what do you want when your entire life revolves around your home? Well, of course, you want a bigger and nicer home. Now, all of these effects that came directly from government intervention, the government buying mortgage-backed securities, incentivizing banks to give out cheap mortgages, the government sending you physical money, sometimes stimulus checks directly to your front door, and that money going in your bank account and not being spent allowed us to afford new homes, the government slashing interest rates down to 0%, making mortgages the cheapest they've ever been in human history, and of course the government forcing you to spend every single waking hour in your home, making you want a nicer and a bigger one, together caused the biggest housing boom in human history ever. Prices were up something like 30% on average throughout this cycle. In some cities, prices were up 50 or 60%, and in some smaller areas, they rose by more than 100%. Of course, though, this was all based on a lie, and it was simply the zombie economy that the government had created, and it was never going to last forever. With these government policies, we saw inflation in the rest of the economy rise as well, and eventually spiral out of control. Of course, the government lies about the levels of inflation that we're seeing too. The real figures are well above 15%, and the government doctored figures are also an eye-watering 8 or 9%. The government and the Federal Reserve in particular have simply no choice at this point. They have to try and fight inflation and bring it down, and there's only one way they can do that, by slowing the entire economy down. So they started to raise interest rates at first steadily and slowly in the first half of 2022, but at this point they're doing it at a far quicker rate, with 75 basis point rate hikes almost being the norm now. Now straight away this does two things directly. Firstly, it makes mortgages more expensive for people because mortgage rates are related directly to the interest rates or the federal funds rate that is set by the Federal Reserve. Secondly, we see bond yields rise as banks expect a higher return from their fixed income assets, and as a result, they want higher returns on all forms of their debt, so that also causes mortgages and interest rates to rise further. Both of these things together make it more expensive to buy a home, and this reduces the total number of home buyers in the market at any one point, and that lowers demand. Now, lower demand leads to lower house prices for homes. Of course, the government also stopped quantitative easing. They stopped buying these mortgage-backed securities, which propped up the housing market, as I'd already said. Banks would give out loans to normal people to buy homes, and they'd instantly sell those loans on packaged to the government. They make a nice tidy profit, and they take almost no risk whatsoever because the government now holds those liabilities. The government, though, is no longer buying mortgage-backed securities. Now banks have to take and hold on to that risk themselves, and this means that banks are just being more cautious lending their money. They're being a little bit more serious and making you go through more hurdles and tougher checks and require higher incomes to buy the same home that you would have bought far easier a year ago. This doesn't make it more expensive to buy homes necessarily, but it does make it more difficult, and it reduces the number of buyers in the market and thus demand. And as we already know, lower demand for homes means lower home prices. There are, of course, though, a bunch of other things that are having an impact on the economy and the housing market right now, and there are just too many to mention them all. Do you remember the eviction moratorium throughout COVID, where banks weren't able to evict people who weren't paying their mortgage? Well, that's now over. Banks can evict people again and then sell those homes on, and that is happening with evictions at their highest point since the 2008 housing crash, and this increases supply. Do you remember the lumber shortage, where fewer homes were being built and sold as a result of skyrocketing costs of lumber? Well, that's now over. More homes are being built, they're being finished and sold and added onto the market, and this increases supply as well. High supply of homes obviously leads to lower prices in the same way that lower demand also leads to lower prices. We're also seeing mass layoffs from loads of different companies. Every other week now, another company like Zillow comes out and fires 1,000 staff because they just can't guarantee their financial security into the future. And these kind of effects will also further reduce the number of buyers in the markets. Basically, right now, we're seeing a perfect storm in the housing market, with everything causing downward pressure on house prices. A crash in the housing market is damn near inevitable at this point, and I'm not personally just trying to jump on this bandwagon like a lot of financial YouTubers were. My video back in November that I showed you just earlier on in this video explained everything that would happen way back then. But the underlying problem here that no one else is really talking about is the banks, the Wall Street firms, the pension funds, and these institutions that were buying up these homes at insane prices, and what this will lead to in the future, because they're now finding themselves in serious trouble. Now, Opendoor is a company that you've probably heard of because they are a massive real estate giant in this space, and they actually became an iBuyer over recent years, which means they would basically buy any house in the entire country almost instantly with almost no checks. As a result of this, they became the single largest buyer in the US housing market over recent years, buying thousands upon thousands of homes every single quarter. They are now, though, projecting to lose $150 million over the next financial quarter. Why is this? Well, because they bought these homes to flip them on for more money, but they simply can't sell them anymore. Early on in the COVID cycle, they would find a home listed for $300,000, buy it with cash with no stipulations for $320,000, and then sell it on a couple of weeks later for $340,000 when demand was high. Demand, though, has now crashed, as we've already established, and it's at its lowest points in about 10 years, and they can't even sell the homes for the original prices they paid for. They now have to sell at a loss, and this is happening all over the country, and not just with Opendoor either. Zillow is another company in a very similar position. They're also a real estate website, and they also decided to become a home flipper or iBuyer. But they got it all wrong. They bought homes for far too much. They couldn't sell them on for their desired prices, and they ended up losing something in the region of 10% on every single purchase they made. Now, they announced back in November that they would stop buying homes at all. They would never buy another home in their entire life cycle, and they'd sell everything that they'd already bought, of course, for a massive loss. 18,000 homes were to be sold just like that, and Zillow found themselves losing $900 million across 2021. There are more companies just like this as well. There's an entire industry based on this flawed idea. Just like Evergrande was the first big Chinese property developer to fall last year in September of 2021, and now the other property developers across China are starting to fall as well, we're seeing the exact same thing happen in the US market, with Zillow being the first iBuyer to start its collapse, but now the others like Open Door and Redfin are starting to follow. Now, of course, some institutions are just in a less bad position overall. BlackRock and certain pension funds, for instance, don't really need to sell the homes that they've bought. They rent them out on the market and they take in those rents for years on end. But before this, they always had the option to sell, and often they would take that option because it guaranteed them quick, large profits, but that possibility is simply no longer there. A lot of these homes were bought by Wall Street institutions on the idea that housing markets only go up, and if they keep holding these assets, these houses, as the market crashes, then they keep taking paper losses, and so they might get to a point where they're forced to sell these assets to put their cash in better assets instead. This could seriously help them if they need to make that kind of change in strategy, and I wouldn't be surprised at all if these institutions find themselves losing billions over the coming few years. It does now seem clear that Wall Street is starting to panic about this. They gambled on a housing market with billions and billions of dollars, and frankly, they got it wrong. Lots of these businesses and these corporations will suffer. Some of them will go bankrupt. If you work for them, that really is quite unfortunate, but if not, you probably don't care about BlackRock losing money. I can't exactly blame you for that either. They flooded this market with liquidity and cash offers of 10% over asking price, and they caused this problem in the first place. Them now having to sell those homes at a loss seems to me like the market returning to its natural state in equilibrium. Prices will fall and normal people will finally be able to get back into the housing market and buy their homes once more, which is not exactly a bad thing. The simple fact here and the overarching idea of this video is that housing prices will almost certainly fall over the next few years. A lot of people think that the housing market is special, but in reality it isn't. It's a financial market like any other, just with a lot slower velocity. Prices are simply a function of supply and demand. Lots of people like to confuse interest rates and think that they directly affect housing prices as well, but in reality they don't. Interest rates merely affect supply and demand, which then goes on to impact housing prices. Supply in the housing market is rapidly increasing at the same time as demand is rapidly decreasing, and there is only one possible outcome from this result. Housing prices will fall. This isn't, though, the end of the world. It could actually be an opportunity for you to get ahead in life. It could be an opportunity for you to finally buy a home that you've always wanted. Be sensible with your money when you find yourself in an economic environment like this. Don't buy a car on stupidly expensive finance that you just can't afford. Live within your means, have a safety net, some savings to fall back on, work hard to keep your job. Hopefully you aren't about to buy a home for 20% over asking price without any contingencies, and you'll probably be okay. Even if you did buy that house though, it still might not be the end of the world. Yes, over the next few years it might fall in value, but you hopefully bought this house to live in it, so live in it. Maybe in 3 years you're underwater, but in 5 years, 10 years, 15 years, or 20 years, you will almost certainly find yourself in a better situation. If you enjoyed this video, then make sure to like, comment, and subscribe to bless the YouTube algorithm. It really does help. If you want to join our exclusive community, then check out our Patreon. You get access to our Discord server and extra content like access to my portfolio and buy and sell alerts for all my own investments. Thank you all for watching. Stay stoic. Until next time.